Hello everyone, welcome to Residencia. In this channel we talk about how to defend your business structure, your international business structure against the tax audit, against your aggressive tax authorities. When I say your tax authority, I mean the tax authority from which you are a tax resident as individual and you are controlling your companies abroad, or you have a structure in your country of residence as well that controls as well these companies abroad. And your company your company abroad is harassed by your tax authorities, and you're not ready because you don't have enough file proofs to demonstrate that your business abroad is genuine, has a real substance, and is compliant with all the anti-abuse rules all around the world put in place by the OCSE, the worldwide organization that all the countries in the world are participating into in order to deliver these conventions, anti-abuse rules and treaties between the countries. So if you are in this situation and you are scared that tax authority might requalify your foreign business as a local one, or you think that your local business has not enough substance, you can contact us. In the description below the video you have our calendar link, because we can help you to understand if your business is weak or it's strong enough to eventually pass a test of a tax audit. Okay, so this is exactly what we do in Residencia. Okay, and for newer business or the client that are already working with us, what we do is to help them to create a daily business proof, day by day business proof, bulletproof defense file ready to be sent to the tax authority in case of controls. Okay, and you can run your business with a peace of mind with issues. Now, in this specific video of today, I'm going to explain you what exactly is the principal purpose test, PPT, principal purpose test, which is one of the 6 anti-abuse rules, six pillar of the anti-abuse rules categories. What does it mean? It means that you have 6 typologies, most common typology of anti-abuse rules. Here in Residencia, in residencia.tax, T-A-X, in our website, we explain exactly what does it means and why you should be very, very conscious about the existence of all these anti-abuse rules, because most likely you are subject to it, you're not even aware of it. And this is one of those which is basically means that the reason why you have established your business in another jurisdiction and you internationally want to control this business either as an individual or through another structure the purpose of establishing this business abroad actually has to be real. Purpose means it's a real business abroad, or you just simply open the structure abroad just to avoid to pay taxes in your local jurisdiction in which you are residing. And that's the reason why at the beginning of this video I said this video is for you that you are residing and you have aggressive tax authorities on your shoulders. So the principal purpose test, what does it mean? I'm gonna give you a very easy example and I'm gonna explain exactly what is the issue, and let's see if you fulfill the requirement of the principal purpose test or you are in danger. And if you're in danger, we really suggest you to click in the description below the video, because we can help you to understand how to fix the problem. We have been assisting a lot of clients about this with this type of issues, and we have assist them and consult them how to build the correct documentation to avoid this issue. Now, imagine you want to invest in European Union, classical example, classical area in which all the anti-abuse rules are in place. Okay, all the countries there, they have accepted all the max typology of maximum number of anti-abuse rules. Okay, so you have your company in the United States or any Canada, Australia, Hong Kong, wherever jurisdiction outside the European Union. Then you want to create a company, an operative company, so a local business in Italy, for example, okay, on the field of fashion brands or touristic field, okay? So you create a company that does a business in Italy. Now, this company is held by an holding. okay? Outside European Union and outside, of course, Italy. So the reason here is to understand that if you find out that the country in which you have established your holding and Italy don't have in place a nice, a convenient tax treaty, most likely whenever you make a profit in Italy and the dividends are coming back to the holding, they will be subject to the ordinary 26% withholding tax rates or 15% withholding tax rates based on the treaty specifications, okay? Just an example. Maybe those are not the real numbers, but this is just an example. So what you do, you go to a tax professional, tax consultant, a tax planner that will consult you, telling you that your country in which you have established your holding has a better convention with another European Union country, which is Luxembourg, for example. And if you create another holding company in Luxembourg, here the tax treaty allows you to give back the dividend in the holding here at 0%, because Luxembourg and the country outside European Union they have together a very nice attractive tax treaty. And what happened is that creating another layer, another holding between your foreign holding and the operative in Italy, so putting this holding in the middle as an intermediate in Luxembourg, allows you to, on paper, exploit two tax benefits. One is the PEX regime. In European Union exists the PEX regime. It means that profit of a company goes to a holding parent company at zero dividend tax. And then you exploit the other treaty, which basically allows you to move the dividend still in zero towards the foreign company. In this way, your tax consultant probably gives you this structure, which is perfectly working fine on paper. But on paper, why? Because what you're doing with this structure, you're actually acting as a treaty shopping. So you're basically exploit the fact that the treaties give you nice, reduced or even zero withholding tax to allow you to receive dividends from Italy passing through Luxembourg, but this will exactly trigger the anti-abuse rules principal purpose test, okay? So, and here the Italian tax authorities might say, in this case is the tax authority of the country in which you are operating with your company, might say, wait, you're giving 0% to a foreign company, Luxembourg, and then 0% to this holding company there. But why you have to put a Luxembourgish company? What's the sense of it? What's the purpose? Where is the test of the purpose of having put in the Luxembourg? Do you have a real reason why, a real substantial economical reason why you have put the Luxembourg holding company in the middle? The real reason we know together is because you don't want to pay taxes, you want to pay zero taxes there, right? And that's the moment you fail the principal purpose test. So Italy triggered the principal purpose test, disqualified this structure, and Italy applies 26% withholding tax. Okay? You screwed up all your structure, your tax consultant didn't tell you exactly this issue, you didn't prepare enough file defense in case your Luxembourg structure was a genuine, because how do you make a holding company, which is an empty shell company, a genuine? As a minimum, you have to, bare minimum, you have to hire a local administrator. But this is the bare minimum. It doesn't even enough to pass this test. So, this to tell you the story. The video is just to tell you this. You can do whatever tax planning you want, as long as the tax planning below, on the fundamentals, there is a substance. Okay, because if you start failing tests, anti-abuse rules here and there, your entire structure fall on the ground. Okay, because local tax authority, in this case, the Italian tax authority, which are one of the most aggressive tax authorities in the world, by the way, they might requalify your foreign company either as an Italian one, because you say, okay, this company probably it's a fake one. Okay, at Luxembourg there is nobody actually there, and then they found out that there is no substance there, so the only reason why you have basically put a Luxembourg company is just because you want to spare in dividends, and this is not a real purpose. This is not something, a real substantial economy, and with a holding company it's more difficult to demonstrate a substantial economy, a substance, and then you don't pass the principal purpose test, the purpose for which you have created this holding company, because we know you did it only for spare the dividend tax. So in the description below the video we will tell you how to deal with this situation, with this structure. It's possible to have them, but with a very initial structure, but some criteria and some guidelines and some papers and documentation that you have prepared in advance, and not the day of the tax audit, because it's already too late. So the amount of documentation and file and proofs that you have to gather, they must be done since the beginning. Also the planning itself, the tax planning, it must also include the entire idea of be ready for tax authorities checks, okay, or contestation or whatever it is. So here in Residencia we help you to do exactly this. If you think you have a structure which might not be complied with some anti-abuse rules, we can help you to understand the risk, the degree of risk, the percentage of risk, and we also can consult you to understand how to fix the problem, how to correct your behavior, your daily business behavior, in order to be automatically compliant with these anti-abuse rules. If you like this kind of content, if you want to know more, if you want to be updated about this notification bell, like button and subscribe the channel to help us grow here in Residencia, and see you to the next video. Bye.